With inflationary trends in sub-Saharan Africa generally experiencing an upsurge despite ease from the global food crisis, Nigeria's consumer price index has been projected to rise above 20% in the month of August. Obviously, we've seen that already. It's 20.52% from 19.6% it recorded in the month of July. Well, the latest report from the NBS shows that the predictions from analysts are actually correct, with the country's inflation rate in the month of August recorded a seventh consecutive monthly increase of 20.52%, making it the highest rate in inflation in 16 years. It will interest you to know that the continuation of the uptrend of inflation has been attributed to exchange rate pressures, as well as the combined effects of insecurity, global supply disruptions, and higher logistics costs. Well, let's do more of this analysis and, of course, understand what it means for us. I'm being joined live in our Lagos studio by the Chief Investment Officer at Afri Invest West Africa. It's Mr. Robert Omotunde. Good afternoon, and thank you so much for your time.
Thank you. It's my pleasure to be here.
We're actually expecting this. But let me start with what were you expecting? I saw a projection yesterday at the Annual Bankers Committee ongoing in Abuja. Someone said 22.5%. But we're having 20.5% coming from the NBS. What's your take around this?
Well, I think that everyone agrees that we are going to see higher pressure on inflation in the months to come. I think with due respect to those expecting 22%, I think that may be a bit aggressive and may not follow the trend for a month-to-month increase, because you will see that for the month of August, we still had a month-to-month increase of up to 1.7%. You know, so that is typically high if you look at it from what we've recorded historically. You know, in a month that you're having 1.7% month-to-month increase, there must have been, you know, something very, you know, major to have triggered that. And if you look at the factors that have contributed, according to what NBS released, they are consistent with some of the issues that we have always reiterated are the main reasons why we will see more pressure. You know, they come from both domestic and external pressure, right? From the domestic pressure, cost of insecurity is being felt on a daily basis on the headline inflation, right? And from the external sector, you will see the disruption in global supply chains, particularly because of the, you know, Russia-Ukraine crisis, which has increased energy prices. And most of the countries in the world are facing it. I mean, this is not just peculiar to Nigeria. You know, we are talking about, you know, Britain or England specifically, you know, recording a double-digit inflation. Yes. You know, you can imagine. And for the U.S. economy, even yesterday, U.S. Inflation data came out. The consumer price index for U.S. came out for the month of August. And it's, you know, against projection of 8.2%, I mean 8.1%, we're seeing as high as 8.3%. And this also, you know, went against what was projected. But 20.52% inflation in Nigeria is, you know, it's a bit worrying. I think the last time we saw it was sometime in 2005, you know, since probably September or so in 2005. That was when we saw inflation at this level before. So, I mean, that's to tell us that something needs to be done from the fiscal and monetary angle to really put a rein on inflation. Because when we have inflation, you know, it benefits no one. You know, it doesn't benefit companies because of higher prices, companies will record lower volume, lower level of output. You know, individuals' income will not be able to, you know, cater for most of their needs, and they are not going to likely see wage increasing at the pace at which, general price levels are increasing. You know, because again, what will determine whether countries can, you know, begin to talk about wage increase is whether they're actually doing well in terms of their output. Yeah, of course. Not necessarily because of nominal increases in their revenue or profit after tax. So, I mean, inflation is not good for anyone, and we need to begin to talk about it. And when you look at, you marry this with the budget that is about to be presented at 19 trillion. 19 trillion. I mean, it tells me that, you know, we are yet talking about how we want to actually put a rein on inflation. Because, you know, we've discussed severally that most times, you know, when you throw money at things, they have their inflationary implications, right? The level of government revenue fundamentals, I would say, right now, may not support the incremental budgeting that we do on a year in, year out. Look at the performance of the budget in 2022 so far. The bulk of it has been supported by Ways and Means, which is currently hitting almost 20 trillion, from the 10 trillion levels as at the end of 2020. So between 2021 and 2022, we are talking about an additional 10 trillion in Ways and Means. This is a monetary, pumping, right? Or what we call helicopter money, right? Within the economy that is likely going to have its impact on price levels, because you are increasing the volume of money supply. Output is probably at the level that it was in the in the previous period, or even lower. So the implication is increase in price, because we are talking about two sides of an equation. There is a money supply side and there is an output side. So when you create money without necessarily creating real economic activities on the other side of the equation, what you're doing essentially is creating inflation. And at the level that we have right now, you should get Monetary Policy Authority to be worried, and even the fiscal authority, because what it then means is that the 19 trillion budget, even though it's higher in nominal terms, if you work it from an increase, from a normalized point of view, in terms of real purchasing power of that money, you may find out that we are actually going to be spending less in 2023 than we had spent in 2022. So these are the grave implication of inflation that we all need to work on addressing, so that we do not continue on this path. In other countries like the US, United Kingdom, this is a major problem for them when they have inflationary pressures such as we are having now, which is common to us, in most instances. But for them, it's not business as usual. That's when they put in all sorts of extraordinary policy measures that helps us to tackle it. If you look at what we have done so far from the monetary policy angle, you see MPR rising, but MPR has been increasing, at least for the last 2 meetings or so.
Yeah,
we've seen
and I'm thinking,
MPR.
Are they going to do that to the next
But even
meeting?
if they do it,
it's not really working.
It's not working. And the reason why it's not working is not far-fetched, right? MPR was raised from as low as 11.5%, and now we are talking about 14%. But the OMO auctions that the central bank conducts remains at 10%, which was the same level that it was when MPR was at 11.5. So it seems like monetary policy authority is just moving the needle on the benchmark interest rate. But benchmark interest rate is meaningless, because it is to the extent to which it guides or it anchors what is happening in the market. That is when it becomes meaningful. But because what we have just seen are increases in MPR over the last 2 meetings, market rates have not shifted a needle, right? Bond yields at some point went higher, and then they are tracking back lower to the level they were before MPR was increased. So those are issues that, will not necessarily, because the idea behind monetary policy anchor is to say when you have a monetary policy rate, it should help to guide all other rates in the economy, which includes lending rate, savings rate, the rate at which people are borrowing money, the rate at which government is issuing security, the rate at which corporates are issuing securities, But we are not seeing that much of an impact, especially from the sovereign securities that are being issued. So these are some of the reasons why it would seem that MPR is rising, but is not working on inflation. If you have raised interest rate for 2 consecutive periods, should we not have seen the impact on the headline?
Of course.
Similar thing happened in the US. Inflation was raised for 3 consecutive periods. The last 3 meetings that the Fed has had. And we are seeing the impact on inflation. The reason why the market reacted for the US yesterday was only because market expected 8.1 and it settled at 8.3. But by far, it has moderated from 8.5 in the previous period to this current period. But in our case, that's not the case. We are seeing acceleration on a month-on-month basis. And I think this should get the authority worried.
I want us to look at some structural issues here now. I'm interested, as it affects cost of doing business, of course, insecurity, which you also identified, and the impact of Russia-Ukraine crisis. Some of these things are beyond us. So does it look like, why is Nigeria's case looking so special? Some say we're not prepared for the rainy days.
We are never prepared. That's true.
We're never prepared.
We are never prepared.
We are never prepared.
we are, that's a consistency, right? We are never prepared, right? Because we have policy choices to make that can help us tackle major macroeconomic headwinds when they come up. But because our choices are not always in line with markets, we always want to game the market. And that's one thing I keep talking about each time I have to speak about this. It's also because we are not prepared to, put in policies that will respect the tenets of market principles, demand and supply, as basic as it is.
Can be scary
as
sometimes.
Basic as it is.
For like FX now.
As basic as it is the bane of our problem. Because look at FS you mentioned, for example, right? At the parallel market, we are talking about over 700 naira, right? But at the official window, we are still talking, that's about over 60%. Spread between the official.
So high.
It is high. The reason why it is high is clear. One thing that determines price every time is the dynamics of demand and supply. The truth is that even at the official window, there is no availability of supply. And that is why, you heard at a point when the Emirates said they were, checking out of Nigeria, and then government had to address their issues, and then they later came back, right? It is because there is no availability of FX even at the official window. And I tell you today, if the Federal Central Bank begins to pump in more FX, you will see moderation at the parallel market. Something happening at the official window, it will have implication on what is also happening at the parallel market. And that's a data point that should send a signal to the authority that the so-called exclusion at the official window is not really working. Because most times we see pressure at the parallel market when there is scarcity at the official window. If those two markets are separated, right, and they are not interlinked, we shouldn't be saying that. But most times when central bank is not supplying FX at the official window, that's when you see more pressure on the parallel market as well. And I tell you today, if the central bank should pump in $5 billion within the official window, you will see the parallel market rate come crashing. That means that there are some FX that are so-called described as ineligible for access at the official window that are finding their way into the parallel market. And that should not be the intention. It just seems like the official window is giving money for free when we have a crisis at our hand and we can, actually, address some of the issues at the official window.
Okay, now with what we have on ground, it looks like there'll be naira surge in circulation as we move towards the end of the year, as we move to the elections, and people, analysts believe that it will get to its peak as we move towards 2023. Is there any impact? Can this have any impact at all around the economy or around inflation figures and all of that?
Definitely. The way to look at it, especially when electionary campaigns are coming up, there tend to be a lot of spending, right? Yeah. Now, most of those spending may not have direct economic activities created because, you just see politicians throwing money at a lot of things for the purpose of winning election. That is naturally going to impact on inflation. Like I explained earlier, whenever you have grown money supply, if you grow money supply by 2% and real economic activities has grown by 1%, you have created inflation. So there must be inflation. So the impact is also that it will, that's why when growth is being computed, you deflate whatever the nominal GDP is to real GDP so that you take out the noise of money growth from that particular equation to now achieve what is the real economic activities. And because economic activities are measured in monetary terms, for the purpose of GDP, if you don't take out inflation, the tendency is that you are reporting what is wrong. So as we go into electioneering, we expect that it will also have impact on inflation. But I hope that the government can begin to tame its appetite for borrowing at the central bank window. Right. Because that to a very large extent can help us moderate to a very significant extent the level of inflation we are facing right now. In fact, ways and means by far is about the greatest threat to inflation as we speak. Because you're talking about, look at the Fiscal Responsibility Act, or the law stipulates that the central bank cannot lend more than 5% of previous year's revenue to the government as ways and means, right? And before the government can give the next ways and means, or the central bank can advance the next ways and means, the previous must be paid. But as in this case, we have seen a pile-up of up to 20 trillion when the actual figure, just look at it, We are talking about almost 20 trillion, value of ways and means. Meanwhile, the actual figure is less than 500 billion if you are to follow the law. I mean, that disparity will cause what we call inflation as well. So as much as most of the factors we have reeled out are cost push, do not forget it happens all over the world. It happens even in developed economies. When you have periods of inflationary pressure such as this, it's an opportunity for economic actors to also take advantage of the system. So prices have increased, but maybe the prices you're seeing in the market should not be as high as it is. But because everyone is feeling the pinch, right? Someone who is selling the tuber of yam may think, okay, I can put additional margin, right? And that additional margin will have inflationary implication, right? Meanwhile, the person should have charged lesser margin, even though there is inflation in the system. So it happens every time, even in the US. It's a problem because, whenever you see inflation, everybody is agitated. Everyone just wants to make ends meet. And in the process of doing that, we rob ourselves, in quotes, because everybody is just trying to see how you can take advantage of the already bad situation, and that's one of the reasons why we have to put a rein on it.
Wrapping up, do you think we can get anything as we move towards the end of the year? Do you think there can be any respite? Do you think there can be any decrease one way or the other?
Well, because, we've seen new highs, right? I would have said towards the end of the year, we should begin to see some respite. But we are getting new highs by the day because the inflationary pressure is not abating, right? So to the end of the year, I'm afraid we may not get a respite because even if base effect plays out, right, we are seeing higher levels again because prices are still rising from the ground of insecurity and, ways and means, monetary financing, as we call it. So I think we just have to manage the situation, but I think the Monetary Authority also can help in a way. Let there be a real transmission between what is discussed and, and the action that is taken at the, monetary policy meetings. Let it feed into market rates. Then we begin to see some cohesion in terms of policy.
Beautiful conversation as usual there. Mr. Robert Omotunde is the Chief Investment Officer, AfriInvest West Africa. Thank you so much for spending your afternoon with us and breaking up this hot news. Thanks for your time.
Thank you.